Good morning, students. I am Dr. Nitin Kumar Agarwal, Associate Professor, Timit Institution, Muradabad itself. So, I welcome you all to today's session that is related to financial accounting. And today, I would like to get you all familiar with the ledger. This is the primary book, one of the books of accounting, or you can say this is the principal book or a collection of accounts. So exactly what is the ledger and what is the ledger posting? Today, I would express my views on this particular topic, that is ledger and ledger posting. As you must be aware that the business transactions are to be recorded in the primary books. So as you have to make the journal entries in the journal, and after that you have to post those transactions from journal to ledger. So that is the ledger posting. So the very first question of the student is that exactly what is the ledger? Ledger, you can say, the group of accounts, the collection of accounts where financial transactions are recorded. It serves as a central repository for organizing and summarizing the financial activities of a business. Ledgers are also the base or the foundation to the double entry system. As you are studying about the double entry system, it means every transaction is having two side effect, debit and credit. So ledger is the essential book for preparing the financial statement at the end of the year. Okay, first of all, it is very important to know about the characteristics of the ledger. How will you identify that we are preparing the ledger or we are maintaining the ledger? The very first thing is organization. Ledgers are organized systematically. It means whatever the transactions you are going to record in the ledger or you are posting the transaction into the ledger, that is with the separate accounts for different types of transactions. For example, maybe you are recording the transaction that is related to assets, liabilities, equity, revenue, and expenses. So you have to organize systematically that you have to maintain a separate account in the ledger. Okay. Second one is double entry system. As you are aware that under the double entry system, each transaction that is recorded in the ledger follows the double entry accounting system where you have to post, you have to enter the transaction two sides in the ledger, that is the debit and credit. Next is the chronological order. Transactions are recorded in the ledger usually based on the date of occurrence. As suppose you are making any transaction on 1st April, so that particular transaction would be recorded in the ledger date wise. As you can say that on a 5th April, if you are making any other transaction, so the very first transaction that was occurred on 1st April, it would be entered into the ledger, and after that the transaction which was occurred in the on the particular date, that is the 5th of April, so that transaction would take place in the ledger. That is the permanent record. Ledger provide a permanent record of the financial transactions because this is the primary book and you are maintaining regularly for a particular year, as a financial year we are talking about. So for the reference, historical reference, for auditing, analysis and decision making, you can say ledger serves you as a permanent record of financial transactions. If you want to track the particular business record or you want to analyze the record, so that time it will help you. Next one is the balancing. The total debits must always equal to the total credits because this is the particular system under the double entry system, and from very beginning you can check where you leave any error or not, because maybe By mistake, if any transaction is left in the debit side and you will take the total of debit and credit, there would be no match. So balancing is there under the ledger. Detail and summary. Ledger contain detailed information about individual transactions while also providing summarized total for each account. So detail is also there, and summary in the form of total. You are gathering the information from the ledger. Accuracy, it ensures or maintain the accuracy. It means this is the key characteristics of a ledger, ensuring that all transactions are recorded correctly and the ledger balances match with other accounting records. For example, suppose there is a particular transaction and you have recorded in the journal. Now, if you are maintaining the ledger, so the same position should be there. If you are taking or you are gathering the information from journal or you are taking the information from ledger, there should be the same result from two books. Auditability, ledgers are designed to be audited. It means whenever the accounting books are audited by the external auditors to verify the accuracy and completeness of the financial transactions, ledgers assist this particular work. Consistency, it means ledger entries follow consistent accounting principles and standard. You are not allowed to follow the different methods when you are maintaining the ledgers. You have to be consistent while maintaining the ledgers. And accessibility, ledger should be accessible to authorized personnel who need to review. It means user of accounting are there and they require any information, financial information. That time there should be access to the user of accounting, and in order to analyze or update financial information as part of their responsibilities, there should be access. Accurate financial reporting. The ledger is also essential for compiling accurate financial statement, as you must be aware that on the basis of the information extracted from the ledger, you prepare the trial balance and thereby you prepare or you would be able to prepare the financial statement like balance sheet, income statement, cash flow statement. So it provides a detailed record of all financial transaction, because at the time of maintaining the ledger, whatever the transactions occurred in your business, every transaction, the materialistic transaction you can see, would be recorded, or the transaction which is having some worth for the user of accounting or can affect the decision of the user of accounting. So that information, that transaction would be recorded in the journal and ledger. And finally, when you would be preparing the financial statement with the help of the ledger or the balances extracted from the ledger, you would be able to prepare your financial statement. When it comes to legal compliance, properly maintained ledgers are crucial for complying with legal and regulatory requirements. They provide the necessary documentation and audit trail for tax filing, regulatory reporting, and external audit. So when it comes to compile with the laws, the documents which are required to provide the basic information, the ledger will serve you. Decision making. The ledgers provide valuable information for decision making processes also within an organization. Managers and stakeholders rely on the financial data from the ledger to assess the financial health of the business. If you want to measure the financial health of any business organization, you can take the help from the ledger posting. Performance analysis. By analyzing ledger data, businesses can track their financial performance over the time. They can identify trends, monitor expenses. Even if you want to control over the expenses and you want to analyze that what is the particular corner of your organization where more expenses are taking place, so you can control, you can review the expenses with the help of the ledger, because the transactions were recorded primarily in the ledger, and now you are having the information from the ledger, the historical records you can see. So when if you want to check, if you want to control over the cost of your business, that time you can rely on the ledger. So the accurate information is provided by the ledger because it is the primary book and it was recorded as per the double entry system systematically. Auditing and accountability. Ledgers facilitate auditing processes because the external auditors require the information, the financial information. On the basis of those information, they can measure, they can go further with the process of auditing with the help of the watchers, with the help of the ledger balances, or they can verify even every watcher with the posting of ledger. So auditors use the ledger to verify the accuracy of financial statement because the auditors, when they are auditing the accounts, they follow the ledger balances because on the basis of those balances the financial statements were prepared. So they go to tally, they go to match the financial transactions which were primarily recorded in the ledger. Now they need to verify the financial statement with those financial transactions which were recorded in the ledger. So it is very important at the time of auditing, and there is a accountability of the accountant to provide the true and the consistent information in the ledger because the accounts or the financial statements may be verified on the basis of the information extracted from the ledger. Budgeting and planning, this is the another characteristics of the ledger. Ledgers play a very vital role in budgeting and financial planning activities. They provide insights into the historical financial data which helps in forecasting future expenses. So if you are going to make the budget of your organization and if you want to recall the data, recall the information, or retrieve any information from your books of accounting that exactly what was the particular expenses or what was the income in the past. So on the basis of these information, you can forecast the future expenses and you can prepare the budget, and the user of accounting or the owners of business can take the decisions, the informed decisions on the basis of the information taking from the ledger. Another very important role of ledger is the risk management. A well maintained ledger enables businesses to identify and mitigate the financial risk effectively. Because if you are monitoring periodically or time to time the ledger from the ledger or taking the information from the ledger, or you are controlling over the expenses, you are analyzing the trends, you can proactively address potential risk related to liquidity, debt management, fraud, and compliance issues. There may be the different issues in the business organization related to the financial data. So if you are maintaining the ledgers accurately, properly, that time you would be able to mitigate your financial risk because you are able to measure the particular trend, you are able to control over the expenses, you are able to analyze the data, and proactively you can address the potential risk. Because if you want to maintain the liquidity, right, if you want to manage your debts, that time you need the information that how much debt is there and how much total cash or other current assets, as you can take the total of all the current assets. So exactly if you want to maintain the liquidity in the business, you can take the help from the ledger balances, that how many current assets are there, what is the amount of the cash with you, and other issues also you can address. Investor confidence. No doubt, investors and the stakeholders rely on the accurate financial information from the ledger to assess the financial stability. It would be no exaggeration to say that sometimes you can take the ledgers or you can analyze the ledgers as a financial statement, because the financial statement are providing you the information related to financial health of the organization. In such a way, the ledger is also providing the information that is the accurate information, because primarily it was recorded when the transactions were taking place. So it helps you to measure the financial health of the business. So investor confidence, no doubt, is built on the basis of the accurate information which is provided by the ledger. Internal control. Ledgers are an integral part of the internal control system within organizations. They help establish checks and balances, prevent fraud and misappropriation of funds, and also ensures the accountability and transparency in financial operations. So whenever it comes to internal control, you can take the help of the ledger, and if you are posting all the transactions which were recorded in the journal and you post into the ledger as classifying or grouping the different transactions in the different accounts. So internal control is facilitated by the ledger posting. Now I would like to focus on the ledger posting. Exactly what are the steps when it comes to ledger posting? Or already you have recorded the business transactions in the journal. Now it comes to post those journals, those transactions from journals to ledger. So the very first step is identifying the transactions. The first step is to identify the transactions that need to be recorded in the ledger. These transactions are typically recorded in journal as cash journal, sales journal, purchase journal, and journal. So the very first thing is identifying the transaction, that what is the transaction you are going to post from journal to ledger. The second step would be select ledger accounts. It means you have to open the different heads in the name of accounts. So determine the appropriate ledger accounts. For example, if there are two heads, suppose you sold the goods for cash. So you are receiving the cash account would be opened in the ledger, and as you are selling the goods, so sales account would be maintained in the ledger. So you have to identify the transaction that is the related to the sales, because all the transactions which are related to a particular account, for example the sale, so you have to record all, or you have to post all the transactions related to the sales account in the ledger, right? But you have to keep in your mind that every time you have to follow the double entry system. As you know that ledger are being prepared under the double entry system as well. So you need, whenever you are posting the transaction into the ledger, that the transaction should give the impact two side debit and credit. It means if you are posting any business transaction, or you are taking the transaction from journal to ledger, so that time if two accounts are there, as we took the example of the sales, the cash sales, so one account would be debited and another one would be credited, right? And record the transactions. Enter the details of each transactions in the respective ledger accounts. For each entry, include the date of transactions. You have to maintain the date, a brief description, and the amount which is to be debited and amount to be credited. Now post to the general ledger. Transfer the general entries to the general ledger, which is the collection of all ledger accounts. Each ledger account has a unique account number and is organized by account type, that is cash account, receivable, and accounts payable. And once you have entered all the transactions or taking the information from the journal, and you have posted to the different accounts in the ledger. So at the end of the year, you have to take the totals, and you have to just monitor that exactly what are the balances of the different accounts. So you have to calculate the balances of different accounts which are maintained in the ledger. After posting the transaction to the ledger account, you can read it and calculate the balances for each account. The balance is the difference between the total debit and credit in the accounts. After that, you have to verify accuracy, review the ledger entries and balances to ensure accuracy and consistency. Check that debit equals to credit. As I told you from very beginning, that you have to maintain, you have to follow the double entry system. So timely, you should tally whether is there any difference between debit and credit. Okay, and now you come to adjust and correct errors. If errors are identified during the verification process, make adjustment. As you know, if something is wrongly debited, so you can go to make that particular record to be credited in the ledger. So you have to go for the adjustment and corrections. Reconcile accounts. Periodically reconcile ledger accounts to the external records such as bank statement, invoices, and purchase orders. So this is the responsibility on the shoulder of accountants also, to reconcile ledger accounts to the different external records. And definitely this will help you to identify discrepancies, errors, or missing transactions. That's why it is suggestible you go for reconciling the accounts with the help of the ledger, right? So now this is the time to know how to practically post the transaction from journal to ledger. And for that purpose, now we would shift to Excel, MS Excel, right? And these are some transactions you can have a look. The very first transaction on 1st April, that is commenced business with cash. So as I told you that before you are going to prepare the ledger, you should have the journal in your hand. And we assume that already the journal has been prepared, and now you would have a look on the journal entries which which already have been recorded with the help of the transactions which occurred in the business. So the very first transaction is commence business with cash. As you see that very first entry on 1st April is cash account debit to capital account, because I would not like to focus on journal entries right now. I assume that already you are familiar with making the journal entries in journal. So I'm just giving you the brief that these are the business transactions on the left side, and on the right side already the transaction have been recorded as a journal entry in the journal. On 2nd April, opened a bank account and deposited cash rupees 50,000. You see that bank account debit to cash account. And on 3rd April, purchase goods for cash, purchase account debit to cash account, and purchase goods on credit from Mr. A, purchase account debit to Mr. A, because when you apply the rules of accounting, as you must be familiar with the rules of accounting on the basis of three accounts: personal accounts, real accounts, nominal accounts. So you can easily make the journal entries on the basis of the rules of accounting, uh, right? And what comes in is debited, as you know, and what goes out is credited, and all the expenses and losses are debit, and gains and incomes are credit, and debit the receiver and credit the giver. So on the basis of these rules of accounting, all the students are supposed to maintain the journal entries in the journal. And on 5th April, sold goods for cash. As you see that cash account debit to sales account, goods sold for cash. And on 6th April, sold goods on credit to Mr. B, because there is a particular party, Mr. B. So it is assumed that the goods is sold on credit, and already it is mentioned in the business transaction that sold goods on credit to Mr. B, that is rupees for 5,000. So Mr. B debit to sales account, right? And on 7th April paid rent by check, because you are giving the check to party in the form of rent. This is the expenses, so all expenses are debited. So you can see that rent account is debited here, and to bank account because the bank balance is reduced by giving the check, and paid salaries in cash. So this is also the expenses, salary account debit to cash account, and received commission in cash because there is a particular income, so you have to make that income credited, and you are receiving the cash, and on the basis of the rule of accounting, that is what comes in is debited. So cash account as you are receiving is debited here, and in the form of commission you are getting any income, so income is credited. And when it comes to withdraw cash for personal use, it is known as the drawing, so drawing account debit to cash account. And bought office furniture, that is the next transaction for cash, so you have to debit the furniture account, and cash account would be created over there. And paid for office supplies because you are buying some material for office, for suppose stationery for example. So if some office supplies are there, so as an expenses you are also debiting this particular transaction, and you have to mention this account, and by mistake it was left to write over here. I'm just mentioning 1500, and in the credit side 1500, right? Received cash from Mr. B, cash account debit to Mr. B, payment is received, and paid cash to Mr. A on 14th April, right? So Mr. A debit to cash account 10,000, and received interest from bank. It is again the issue, it is again the case of income, so you have to make interest account as a credit, and bank account is, it means the bank balance is increased by receiving the interest from bank, so you have to make the bank account debit by rupees 500, and to interest account 500. Now this is the time to post into the ledger, because already you are aware of the journal entries in the journal. So one by one, each transaction which has been recorded in the journal, we have to pick up and we have to post into the ledger. So as I told you that ledger is the collection of accounts. As you can see that already I have maintained the different formats of accounts. The same format is there for the different accounts, and right, you can see over here the different accounts we have to maintain into ledger. But now because you have to be familiar with the different accounts to be maintained in the ledger. So the very first thing is that from very beginning you have to focus that how many accounts, or what particular head is there to be opened in the ledger. So the very first transaction is cash account debit to capital account. So cash account would be opened, would be maintained in the ledger, and capital account would also be maintained in the ledger. And in the second transaction, as you see the bank account, there is a particular transaction related to bank and cash. So already in the first transaction you have opened the cash account. Now again there is an entry that is consisting of the cash account again. So you don't need to open cash account two times, right? You have to open the cash account on a single time, and all the transactions related to cash account would be debited or credited in a same place, that is the cash account, right? So you have to open cash account in the ledger, you have to open capital account in the ledger, you have to open bank account in the ledger. Again there is a cash, so you have to leave it because already you have opened the cash account, but all the transaction would be maintained in the ledger. Right now I am just trying to give you the information how to open the accounts or the heads in the ledger. And because the new transaction, that is the purchase, so purchase account would be maintained in the ledger but not the cash account, as I told you earlier, right? Again there is a case of purchase account to Mr. A. So purchase account which already was opened for the transaction which was occurred on 3rd April. So already you have opened the purchase account, you have maintained the purchase account in the ledger. So for the transaction that is taking place on the 4th April, and purchase account would not be opened again, right? So all the transaction related to purchase would be maintained in the same purchase account, and Mr. A account would be also opened, and cash account already you have opened, and sales account you have to maintain, right? So practically now we have to maintain the very first account. I told you that cash account and capital account and bank account. Okay, so we have to open uh, cash account, and we have to open capital account, and we have to open bank account, right? And just go upside and find already you maintain the cash account, capital account, bank account, right? Purchase account you have to open, right? And A account and sales account, purchase A and sales, right? So you have to give the name purchase account and Mr. A account, right? And sales account. Okay, so you have to focus that how many transactions are there, and as per the need you can easily open the different accounts. So sales accounts you maintain, and Mr. B you have to maintain Mr. B rent and salary, Mr. B rent and salary, right? Mr. B, okay, Mr. B account and salary account, right? And another one was, if you had a look on it, that was the commission account. Okay, and again we go upside and find that how many accounts are to be opened now. Commission, now drawing account, furniture, office supplies, right? Drawing account, okay, that is the drawing account, and office supplies account, right? Okay, office supplies, and bank account already opened, I think, because there was a transaction, right? This one, and interest account, I think we have not opened the interest account till now, so we have to open interest account, and A and B. Mr. A's account already open, right? And Mr. B account is open, and we have to open the interest account because you received the bank interest, so you need to open interest account here, right? So we have opened the different accounts as per the need. So I just told you that how will you identify that which transaction is related to which particular account, because there is no need to open the different accounts many times in the ledger. You have to open a particular account for the same transactions for the same heads, right? If there is a record of cash many times, so you have to maintain a cash account in a ledger, and all the transactions which are related to cash account would be uh, entered into the particular account in the name of cash, right? So now it is the time to post the particular transaction or these transactions as we took for the example, right, into the ledger. So how will you post it? Very specifically I am just focusing on that how to post the different transactions into the ledger. So the very first transaction is cash account debit to capital account. So you have to observe that the cash account is debited in the journal entry. So you have to approach to the debit side of the cash account, and the opposite side, that is the capital account, the opposite account, or you can say in the credit side it is mentioned the capital account. So in the debit side of cash account, again I am repeating this, that there is a particular transaction in the journal entry, cash account debit to capital account. So the how, what is the way, how will you post this particular transaction or this entry into the ledger? So you have to observe the debit side. Here you see that cash account is debit, so you have to you already opened the cash account in the ledger, so you have to approach to that cash account, and you have to approach the debit side of the cash account, and you have to maintain, you have to mention to capital account in the debit side of cash account, because the opposite account of cash, opposite the credit side of this cash account debit is the capital account. So in the cash account you have to make the capital account, right? So cash account debit, you have to go to the cash account. This is the debit side. Okay, I just mentioned for you that this is the debit side of the laser, and this is the credit side. Okay, so you have to maintain the laser on 1st April, so you have to mention the date, that is April 1st, and in the particulars you have to write to capital account rupees 1 lakh, right? And again, because there was the entry cash account debit to capital account, so you need to go to the approach and approach to capital account, the credit side, and you have to write down here by the opposite account is the cash account rupees 1 lakh. Okay, so I think you develop the understanding that the very first transaction was cash account debit to capital account. So how do you maintain the ledger, that in the cash account, in the debit side of the cash account, you have to mention the name of the capital account, and in the credit side of the capital account, you have to mention the cash account, right? And the amount was the rupees 1 lakh. And now take another transaction, that is the bank account debit to cash account. It means in the bank account debit side, you have to approach to the debit side of the bank account and mention the opposite, that is the cash account 50,000, right? So we approach to bank account, again we go down and find where is the bank account, right? And I think we have opened back around this one, yes, uh, bank account, right? So this is the bank account and the cash account was there. So what was the transaction? Transaction was that bank account debit to cash account 50,000, right? So bank account debit. So you have to mention here to cash account, and the amount is 50,000, and because the cash account was credit, so you have to mention in the credit side of cash by bank account, and that was the 50,000. Okay, and whatever the date was, you have to mention that this was the April uh, 2nd, okay, right? And the same date in the bank account, that it was April 2nd. Okay, now we come to another transaction, that is purchase account debit to cash. So I think the students very quickly can post this entry, the purchase account debit to cash. So in the purchase account debit side, you have to mention to cash account, and in the cash account by purchase you have to mention, because the purchase was debit. And you can observe that if you are making anything credited in the cash account, it means the cash is reduced. So if you are purchasing the goods, so by writing here or by mentioning here the purchase account, you are reducing the balance of cash in the credit side by purchase account, right? And what was the amount was 20,000. So in the cash account you have to write 20,000, and purchase account you have to mention, right, uh, to cash again, that was the written, so you have to write just 20,000 the amount, right? And on the particular date, the purchase account debit to cash account on 3rd April. Okay. And the next one is the purchase account debit to Mr. A. It means you are purchasing the goods on credit from A. So you have to mention in the purchase account to Mr. A, and in the credit side of Mr. A, you have to write down the purchase account in the credit side of Mr. A, right? So purchase account debit, the step by step we follow this particular transaction, that purchase account debit 15,000. So in the purchase side, right, in the debit side of purchase account, so this is the purchase account. In the debit side you have to mention to Mr. A, and 15,000 was the particular amount, and Mr. A was credited in the journal entry. So you have to approach, you have to go to the credit side of Mr. A, and you have to mention here by purchase account, right? And what was the amount? It was the same amount would be entered into the ledger of Mr. A, right? So now you have already posted purchase account to Mr. A. Now it comes to 5th April, that is cash account to sales. So in the debit side of cash account, right, you have to mention sales account. So we come to the cash account and post the entries. Cash account debit to sales, it means sales to sales account. And what was the amount? Again we can see 10,000 cash account debit, right, 10,000. And in the sales account, if you approach in the sales account, right, so here you have to write by cash account, and the amount is 10,000, right? We have posted this particular entry, and if I am not mentioning the date, you can easily mention, right, for because you are having the understanding that how many columns are there and how to maintain those columns with the information. So if there is a particular date of transactions, you have to mention, right? And there is a particular transaction of Mr. B on 6th April. Mr. B debit to sales. So Mr. B and sales, right? Mr. B and sales, but just take the amount, how much amount was given, that Mr. B to sales 5,000, right? Mr. B to sales. So you have to go to the Mr. B's account and sales account. Okay, we just find the sales account, so we have to write here by Mr. B, right? And 5,000 because it was the transaction of credit. Okay, and you find Mr. B, so you have to write down this to sales account. The amount is 5,000, right? And 6th April, after this particular transaction, you come to 7th April, that is rent account debit to bank 2,000, rent account debit to bank 2,000. Okay, so you have to find out where is the rent account. I think we have not opened the rent account, no issue. We just open it, the rent account. right? Okay, so rent account, because the transaction was rent account debit to bank 2000, so bank account is here, rent account debit to bank. So by rent account, and you have to mention 2000, because why we are writing in the credit side again, for your understanding, that the bank balance is reduced when you are paying the rent, right? So bank balance is reduced, and if you are receiving into banks, a bank account would be debited over there. But right now, because the rent is paid by the organization, so you have to mention the rent account in the credit side of bank. Okay, and rent, what was the amount that you write down? The rent 2000, and in the rent account you have to make this entry, because I told you that you have to follow the double entry system. So in the rent account debit side you have to mention to bank account, and the amount was 2000. Okay, and we come to another transaction, that is salary account debit to cash account. So you have to mention in the debit side of salary to cash. Okay, so salary to cash 3000. Okay, we find the very first cash account, so we can mention here by salary account 2000. Okay, and you have to find the salary account, and salary account debit to cash. So you have to mention in the salary account to cash account 2000. This is the particular amount, right? Again we approach to the transactions, right? Salary account debit to cash, it was a 3000, right? So we have to correct this error, that it was written by mistake 2000, so you have to write the 3000. Okay, we just make it corrected, and it is 3000. Okay, and in the salary account you have to mention 3000. Okay, this is not the 2000, it was 3000, so we just corrected 3000. Okay, and what about another transaction? It is cash account debit to commission 1000. Cash account debit to commission account 1000, and in the commission account you have to write credit side. Okay, so this is the commission account by cash, because commission was received, it is the income, and income is credited. So you can observe that we are writing as per the rule of the double entry system, that in the income account you are mentioning that through cash you are receiving this particular income, so you have to mention the cash account right over here. uh, this is the amount, rupees 1000. Okay, so cash account debit to commission account, there was a particular entry of rupees 1000. Another transaction on April 10th, you find that drawings account debit to cash 2000. Drawing account debit to cash. Okay, by drawing account, right? And what was the amount? 2000. So cash account 2000, and I think it was the mistake, so we just make it correct, right? And 3000. Okay, and drawing was credited in the cash account rupees 2000. Now it is the turn to make drawing account debited by with cash 2000. So we have to approach to drawing account, right? This is the sales account, fees account, and salary account, commission account, and office supplies interest account. I think it was left without opening, so you have to maintain the uh, drawing account, right? And in the drawing because you are withdrawing the cash. So entry was that drawing account was debit to cash account. So to cash account you have to mention, and what was the amount? Rupees 2000. So drawing were made over there in the business organization, and you have to mention the 2000 as a drawing, right? And again we go to the transaction, and it was on April 11, that is furniture account debit to cash account. It means you are buying the furniture, so cash is reduced by furniture, then you have to post here by furniture account, right? And amount was 10,000. 10,000 or 5,000, we just check it. It was 5,000. Okay, so we have to mention here rupees 5,000, right? So already cash has been reduced. Now you need to make this entry in the furniture account, because furniture was purchased, so furniture is asset, and all the assets are debited when you are purchasing. So in the furniture account you have to mention furniture account. You have to approach first, and just we go to furniture account, right? Where is the furniture account? We try to find it. It was open or not? I think it was not open, so we have to open it. Furniture account, right? Okay, no issue. We just open the furniture account. Okay, we just copy and paste, right? And furniture furniture account. Okay, so every account is to be opened, and you have to mention that 5,000 rupees. Okay, so we have to mention that furniture was purchased for rupees 5,000, so you need to correct the amount rupees 5,000. Okay, so furniture account is opened over here, and again we check this, what was the exact transaction. Furniture account debit to cash 5,000. So we mentioned in the cash account buy furniture, because the cash was created in the transaction, so we have to make this furniture account credited in the cash account, and in the furniture account the cash was debited, right? So office supplies account, the next transaction on April 12, office supplies account debit to cash 1,500, right? Office supplies to cash. So by office supplies account 1,500, and office supplies account we need to approach to cash 1,500, right? So this is the office supplies account, and you have to mention to cash account because it was assumed as the expenses, so you need to make it debit here, right? And we find the another transaction to be posted. So already number of transactions you have posted in the ledger and office supplies. Now it is the turn to make the entries of the transaction which was occurred on April 13. So cash account debit to Mr. B. So you have to approach to cash account, and you have to mention to Mr. B, right? So Mr. B, and what was the particular amount? Mr. B 5,000. Okay, 13th April 5,000. So you have to mention 13 April, right? Date 5,000 amount, and 13 April. Okay, so just don't forget to mention the date, because this is the example. Maybe I am just leaving to mention the dates sometimes, but you need to mention every transaction with every bit of information. It means you have to record all the dates, all the amounts, and debit and credit, and each transaction would take place in the two different accounts, debit and credit side, because this is the system of the double entry, that in while you are maintaining the ledger, the particular account would be debited and the opposite account would be credited as per the rules. So we have mentioned to Mr. B in the this particular account, cash account, because the cash was received from Mr. B. So you mention the B's account in the cash, and in the B account, right? You have to approach to the B account. Okay, we just approach to B account, and the B account, you, because you are receiving the cash from B, so you have to write here by cash account, right? And the amount was rupees 5,000, and date was April 13, so you have to mention the date April 13, right? And again we have to look that what are the transactions to be left over there to be posted in the ledger. On 14th April, you find that Mr. A debit to cash account, so cash account credit 10,000, Mr. A, Mr. A, right, 10,000. And what was the date particular? April 14th. Mr. A, and because the transaction was, you paid cash to Mr. A, so in the credit side of cash you wrote Mr. A, and in the debit side of Mr. A you have to mention to cash 10,000. So we have to approach to A's account, and that is this one, right? Mr. A to cash account 10,000. Okay, so that was the transaction on 14th April. So you have to mention the date April 14, right? And now the last transaction which was left to be posted, it is on 15th April, bank account debit to interest account 500, right? So bank account debit to interest, okay, that was the interest account here. So by bank account 500, and this was the transaction on April 15th, right? And we have to go to the bank account where because the you are receiving or paying the interest, you have to see in the transaction, as you see that interest is received, so bank account debit to interest. So in the credit side of interest you mention the bank account, and in the debit side of bank you have to write the interest to interest. So you need to approach to bank account, this one, and because to interest, right? Bank account, it means the balance of bank is increased by receiving the interest, so you have to mention here to interest account. Okay, and the amount is 500, so you have to mention, and the date is April 15th. So I think now you are familiar with the different transaction, how to post in the ledger. So bank account debit to interest account, because it was the case of transaction, that is the income you are receiving. So bank account debit, so in the debit side of bank account you have to mention the interest account, and in the credit side of interest account you have to mention bank account, right? So 500 already you have mentioned. Now how to close a particular account and how to take the balance, it is the time to learn about it, right? So the very first thing is that you have to take the total, and are you have to take the total, but you have to check whether what particular side of account is having the more balance, because first the total would be taken of any account which is having the highest or total in comparison of other side. So as you see that just example 1 lakh 10,000 15,000, so just we take the total of it, right? For example, uh, this is your uh, sorry, I just take this total, okay, and this is your 1 lakh 16,000, okay, just we mention here just e- this one, right? For example, okay, we just make it correct and we find the total. What is the total? Okay, it is showing wrongly. So manually we just take it and we just write down 1,16,000. Okay, 1,16,000. Right. And what about this total? This is 91,500. So you just observe that the debit side is highest in comparison of credit side. So you have to uh, write down 1,16,000. Okay, 1,16,000 is the same. It means you have to mention the total of for debit side and you have to mention the same total in the credit side, and now you have to take the balance by balance CD carry down. It is the carry down, and the total was total of credit side was 91,500. Again we can take the total, right? What about for checking? It is 91,500. So you have to reduce, you have to just take the difference, this one minus 91,500, and you find 24,500. 24,500. Okay, so this is the particular balance of this account, and you have taken the total, right? So this is the particular total of this account, the cash account, and this was the balance, right? And this balance would be carried down, right, brought down in the debit side, in the other side. Okay, so to balance uh, brought down, right? And what was the amount? To 24,500, right? So this is the particular system, as you can see, that how to close an account by taking the balance. So first of all, you have to take the total of both the side, and as comparing both the total, if you find the highest total debit of the debit side, then same value would be written in the credit side, and you have to take the balance after subtracting the total of credit side, right, from the debit side balance. So as per this cash account, as you see, the debit side total is rupees 1,16,000 and credit side total was 91,500. So you have to subtract the total of credit side from the total of the debit side, and you find the particular balance. So you can see that this 24,500 is the balance of cash with the organization. So this is the particular summary, and now I think that the students are familiar with the ledger, the how to post the transaction into the ledger from the journal. So it is very important to observe that how to make the ledger with the help of journal entries, right? So already you have mentioned, you have generalized the transactions into the journal, and from journal you are maintaining the ledger, and at the time of closing you have to take the balance, because this particular extracted balance will help you while preparing the trial balance, and with the help of the trial balance you would be able to maintain the financial statement, you would be able to prepare the financial statement at the end of the financial year, right? So I think it is enough to understand, to develop the understanding of the ledger and ledger posting. So this is again to repeat that ledger is nothing but the you can say the total accounts you have to maintain in a particular place, the different accounts for the different transactions. Okay, so you can say the ledger is the collection of accounts, is the collection of or you the group of accounts where you have to maintain all the records, all the transactions which were primarily recorded in the journal, and now you have to make those transactions to be from journal to ledger. So this is the particular posting, ledger posting, where you are taking the every transaction from the journal to ledger, and you have to maintain the different accounts as a group of accounts. So this is the particular book, this is the particular you can say the record of business accounting, where you can rely on the accurate information, and with the help of the ledger posting, the user of accounting take the informed decisions and check the financial health of the business organization, and can go for analysis of the business accounting data, right? So I think it is enough for the session, and I hope that now easily you can enter the transactions into the journal, and with the help of the those transactions which already recorded in the journal, you can post into the ledger by making the different accounts. So thank you very much.